Hello, and welcome back to the channel. I'm Algabot, and today we're taking a close look at an expert advisor for MetaTrader 5 called Mann-Kendall Trend Confirmation. This is a trend-following strategy built around a fascinating piece of statistics, the Mann-Kendall test, a rank-based method that measures whether a run of prices is climbing or falling more than random chance would allow. Over the next few minutes, we'll explore how the strategy defines a trend, how it times its entries on shallow pullbacks, and how it manages risk with stops and targets. Remember, this is educational content only, so let's dive in. So what exactly does this expert advisor do? At its heart, Mann-Kendall Trend Confirmation is a trend-following system, but the way it decides whether a trend actually exists is what sets it apart. Most trend tools lean on a moving average slope or a regression line, and both of those can be thrown off by a single unusually large candle. The Mann-Kendall test takes a different route. It's a nonparametric, rank-based statistic, which is a fancy way of saying it looks only at the order of the closing prices, not the size of each move. It asks a very precise question. Is this sequence of closes rising or falling more than random chance would allow? Because it ignores the magnitude of each move. A handful of outlier candles cannot fake a trend that isn't there, and they cannot hide a trend that is. The strategy converts that test into a single standardized number called a z-score. When the z-score climbs above a chosen threshold, the strategy treats the market as a confirmed uptrend. When it falls below the negative of that threshold, it reads a confirmed downtrend. This EA is designed with trending markets in mind, such as major foreign exchange pairs like the euro against the US dollar, or metals like gold, typically on the 30-minute through 4-hour time frames. That said, the time frame is never hard-coded, so it runs on whatever chart the tester selects. In terms of who it suits, this is educational material for traders who are curious about statistically grounded trend filters and who prefer studying dips within uptrends and rallies within downtrends rather than chasing extended moves. As always, trading carries real risk, and losses are a normal part of the process. Let's walk through the mechanics step by step, exactly as the code lays them out. On every new completed bar, the strategy gathers the last 20 closing prices. That count is the MkPeriod parameter and runs the Mann-Kendall calculation. For every pair of closes in that window, it compares the later price to the earlier one. Each time the later close is higher, it adds 1. Each time it's lower, it subtracts 1. Summing all of those comparisons gives a figure the statisticians call S. A large positive S means almost every pair is rising, a clean uptrend. A large negative S means the opposite, and a value near zero means there's no real order to the prices, just chop. The strategy then standardizes S into a z-score by dividing by the square root of its expected variance, applying the usual small continuity correction. The default significance threshold is 1.64, which corresponds to roughly 95% confidence. When the z-score is at or above that level, the market is a confirmed uptrend. At or below the negative of it, a confirmed downtrend. Now for the entries. The strategy does not buy the moment a trend appears. Instead, within a confirmed uptrend, it waits for a shallow pullback. Specifically, it looks for the prior completed bar to be a red pullback bar, where the close is below the open, and then for the just completed bar to be a bullish reclaim that closes back above that pullback bar's high. When all three conditions line up, the strategy signals along. The short side is a perfect mirror. Within a confirmed downtrend, it wants a green pullback bar, followed by a bearish bar that closes below that pullback bar's low. Risk management is built in from the start. As soon as a position opens, the stop loss is placed at a multiple of the average true range, the AtrStopMult parameter, defaulting to 1.5 times ATR. The take profit sits at a reward to risk multiple of that same distance, defaulting to 1.8. So the target is meaningfully wider than the risk on each position. Finally, there's an active exit rule. If the Mann-Kendall z-score flips and becomes significant in the opposite direction while a trade is live, the strategy reads that as the trend reversing and closes the position early, rather than waiting for the stop to be reached. And it never stacks a new entry on top of an existing one. Let's read through the core of the MetaTrader code you see on screen. At the top are the key input parameters. MkPeriod, set to 20, is the number of completed closes fed into the Mann-Kendall test. ZThreshold, defaulting to 1.64, is the significance level the z-score must reach. ATR period and ATR stop multiple govern the stop distance, with the stop set at ATR stop multiple times the current ATR. Reward-risk ratio, at 1.8, sets the take profit as a multiple of that stop distance, and lots is simply the order volume. Below that, the strategy calls its Mann-Kendall function to get the z-score, then defines two flags. Uptrend is true when z is at or above the threshold, and downtrend when z is at or below its negative. Now look at the long block. The long setup condition requires all of the following. Uptrend is true, the pullback bar closed below its open, the just completed bar closed above its open, and that bar's close pushed above the pullback bar's high. When every part is satisfied, the code reads the ask price, places the stop loss one stop distance below it, sets the take profit at the reward to risk multiple above, and calls trade.buy. The short block is the exact mirror. The short setup condition asks for downtrend, a green pullback bar that closed above its open, a just completed bar that closed below its open, and a close beneath the pullback bar's low. When those align, the code takes the bid price, places the stop one distance above, sets the take profit below, and calls trade.sell. Both sides share the same symmetric logic, just reflected. Now let's bring it all together on this illustration. Across the top you can see the price candles, and in the panel below is the Mann-Kendall z-score, our statistical trend gauge. The green dashed line marks the positive threshold at 1.64, the red dashed line marks the negative threshold, and the flat middle line marks 0, meaning no directional order. Watch the first few candles on the left. Price is stepping steadily higher, one green candle after another. And notice what the z-score does underneath. It climbs from below 1, up through the green threshold line, and settles comfortably in the upper zone. That tells us the run of closes is rising more than random chance would allow, a confirmed uptrend in the strategy's own terms. Now comes the setup. Instead of chasing that rally, the strategy waits patiently. After the steady climb, we get a small red pullback bar, where the close slips below the open. This is the shallow dip the strategy is looking for while the trend gauge stays elevated. On the very next candle, buyers step back in. This bar closes higher, and crucially, it closes back above the high of that red pullback bar. That reclaim, combined with the z-score still holding in its uptrend zone, completes the long setup, and you can see the buy entry marker appear right there. With the position open, the stop loss sits roughly 1.5 times ATR below the entry, and the take profit is placed at 1.8 times that distance above. Follow the next couple of candles. Price continues to press higher, extending the move, until it reaches the take profit target marked on the chart. That's the long trade complete. A pullback studied inside a statistically confirmed uptrend. Now watch how the picture changes. After that peak, the candles begin to roll over and turn red, and the z-score in the lower panel starts falling. It drops from the upper zone, crosses back through 0, and then pushes down through the red threshold line into the lower zone. The statistical trend has flipped. This is now a confirmed downtrend. The short setup mirrors the long exactly. Look for the green pullback bar inside this decline, a bar whose close ticks above its open, a brief bounce against the falling market. On the following candle, sellers regain control. It closes lower, and it closes below the low of that green pullback bar. With the z-score sitting firmly below the negative threshold, that bearish break completes the short setup, and the sell entry marker appears. From there, risk is handled the same way as before, just reflected. The stop loss is placed roughly 1.5 times ATR above the entry, and the take profit sits 1.8 times that distance below. The final candle carries price lower into the take profit target, and the short trade is done. Notice the discipline in both examples. The strategy never simply bought because price was rising or sold because it was falling. It first required the Mann-Kendall z-score to confirm a genuine, statistically significant trend. Then it waited for a shallow countermove and a decisive reclaim or break in the trend's direction before committing. That is the whole idea. Use the rank-based test to filter out choppy, directionless markets, and only act when both the statistics and the price pattern agree. And remember, had the z-score flipped against an open trade before the target was reached, the strategy would have closed that position early on the reversal rather than waiting. This is an illustration of the logic for educational purposes, not a prediction of how any real trade would unfold. And that brings us to the end of our deep dive into the Mann-Kendall Trend Confirmation Expert Advisor. Today we unpacked how the Mann-Kendall test turns a run of closing prices into a single Z-score, how the strategy uses that score to confirm a trend, and how it then times entries on shallow pullbacks with ATR-based stops and a reward-to-risk take-profit. We also saw how it steps aside and exits early when the trend statistic reverses. Everything here has been for educational purposes only, and nothing in this video is financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.